they'll actually set up an IRA LLC within the IRA, fund the LLC, and once the LLC is funded, the LLC is owned by the IRA, right? So now you can go and purchase property. Now, that's if the client wants control, like they want to be hands-on, right? If the client doesn't want control, they want passive investing, what clients do is they find companies, syndication companies, real estate companies who have these offerings, whether it's Reg D, Reg CF, Reg A, they have put together an offering, and like say the minimum investment is $50,000. They'll invest into the offering directly from the IRA.
Are you looking to achieve massive success in your life without dealing with costly investment nightmares? If yes, then this is the podcast for you. Here, we provide engineers and busy professionals all the secrets and strategies to create multiple streams of income, build generational wealth, and live a meaningful life by design. Here's your host, Ted Patel.
Hey everyone, this is Ted Patel, and welcome to this week's edition of Decoding Cashflow Podcast. I'm here with Donna Udumulla. She's an investment manager at Madison Trust Company and brings a wealth of experience in alternate investment industry. With her expertise, Donna has helped numerous clients achieve their investment goals through self-directed IRA accounts. As a certified IRA service professional, Donna specializes in IRAs and alternative investments such as real estate, private equities, cryptocurrencies, and many more. Donna, welcome to Decoding Cashflow. It's a pleasure having you on the here.
Thank you so much, Dad, for having me today. It's good to be here.
Awesome. So we'll dive deep into the self-directed IRA, pros and cons, as well as what are the different investment strategies that can be implemented under these accounts. Before we dive deep into these niche, right? Can you give us a little bit more background about yourself? What do you do at Madison Trust? I just covered a couple of lines of your bio. Maybe you can just expand a little bit over here.
Of course. So my background, my original background is in traditional finance. Of course, I first got my feet wet with a boutique financial firm, the usual stocks and bonds. And then when I did my master's in financial analysis at Rutgers, I got a little bit into alternative investments, and we're talking real estate, private equity, venture capital. And at that time, I had the privilege of already working at Madison Trust and just being able to climb up the ranks. And then I ended up getting promoted to the investments manager. And today I oversee a very sizable portfolio of $4.2 billion in alternative investments, just ranging across it's really a huge variety, Ted. When I tell you I have seen real estate, I've seen Arabian racehorses, movies, Broadways, like people really, really get creative when it comes to alternative investments. So today I oversee the investments team at Madison Trust, as well as the sales teams and the business development teams, just seeing how can we expand and create brand awareness and also educational awareness to show people, hey, there is something beyond Wall Street. You don't have to always put all of your eggs in one basket. That's Wall Street. Stocks and bonds, you actually can buy a rental property from your retirement money. And then by the time you're getting ready to retire, you can take it out of your retirement account and have that personally. So that's really what I do at Madison Trust. It's a fantastic job.
Awesome. So just to begin with, right, you mentioned getting away from the Wall Street. I know the employers here, right? If you're doing W-2, the employers have their own custodians. They have their own IRA account, the companies who manages their account, right? You cannot roll that into the self-directed. What is the point where you suggest they can roll or become eligible for self-directed IRA?
So I get this question a lot. A lot of people assume just because you're already employed with that company and you have the 401k or the qualified retirement plan with that company, you're not able to roll over. It really is dependent on the plan documentation. Every plan is structured differently. So what I always suggest, especially to my clients when they come to me with this question, Donna, I've been working at this company for 25 years. I'm still working there. I have a 401k. I don't think I can take it. You need to first talk to your plan administrator and ask them, is there a portion of my qualified retirement plan that I can roll over? If so, how much? If they say
Yeah.
yes, and sometimes they might say no because you're employed with the employer, you're not eligible to roll it over, then you're gonna have to wait until either you move over or retire. If not, the partial amount that you're able to roll over, you can absolutely roll it over to a self-directed IRA. So
Mhm.
first rule of thumb is it's always best to verify.
Always check before you assume.
Exactly, always check.
All right, that's good. And of course, once if you are switching the employers, then that's the best time to
Best
roll
time,
over, right? If you wish to.
correct.
Yeah.
Best time, because I think rolling over a old 401k, let's say, to a new 401k is more complicated than people will assume versus rolling over, taking that check and setting up in a self-directed IRA and depositing that check is so much more easier. Another little known fact is when you're rolling over, you actually have 60-day period. So within the 60 days, you have 60 days to take that funds and put it into another qualified retirement plan or an IRA. So, sometimes individuals get a little stressed out because they're like, I need to do this immediately. Don't worry, you have 60 days.
Sure. And and you got to find the custodian also, right? Within the 60 days. So
Correct.
so if someone is planning to start as self-directed IRA, how do they go with finding a good custodian, and what are the criterias that you would say they need to keep in consideration while selecting a custodian?
So when it comes to self-directed IRAs, the first thing I want people to understand is the difference between a self-directed IRA and a standard IRA. Everyone has a Charles Schwab, Merrill Lynch, Morgan Stanley standard IRA that's very much into stocks and bonds. The difference with a self-directed IRA is you're able to invest into anything other than stocks and bonds. We're talking absolute alternative investment. Right now, cryptocurrency, precious metals, real estate, they're hugely popular, right? There are a lot of self-directed IRA custodians in the industry, and Madison Trust, of course, is one of them. When you are selecting a self-directed IRA custodian, a few things are very important. One, you need to first figure out, is self-directed what you're truly looking for? Do
That's true.
you have a good deal you want to get into? Do you have a good real estate deal you want to get into? You can't just set up a self-directed IRA account and assume the custodian will find the deals for you, because that's a common misconception too. Because the self-directed IRA custodians are actually not fiduciaries. So we're not able to give investment advice. So one, you need that deal. Once you have the deal, you need to do your research. I would definitely suggest searching up a few self-directed IRA custodians, setting up some consultation calls to understand what are their fees, how are they structured, how is their customer service? Customer service is very important, Ted, because self-directed IRAs can tend to get complicated if you don't know what you're doing. So being able to get someone on the phone, someone who answers emails, check their Google reviews, their online reviews, their phone numbers. Are you able to easily get a hold of somebody? Then, of course, the process is setting up the IRA easy, or is it causing you more work? So those are the little, I mean, they're not little, they're very big things, important things you want to take a look at before you actually select a custodian. And another thing I would also say is, don't be alarmed if you feel like it's a lot of information, and don't feel pressured to choose a custodian just because you only have 60 days. That's not true. If you didn't roll it over, you can keep the funds at the previous 401k until you decide. And of course, finally, always talk to your financial professionals, whether it's your financial advisor, whether it's your CPA, whether it's your attorney who's handling your finances. Please talk to them and make sure that this is the right decision for you financially. Sometimes if the only thing you have is the $50,000 in that 401k, I personally wouldn't recommend putting all of that into a self-directed IRA without a good deal. So these are the things I would always tell my clients to take a look into.
Awesome. And what are the normal fees for self-directed, like percentage-wise, average?
So it is actually dependent on the custodian. Every custodian has different fees. Now, at Madison Trust, what we like to do is, and this is why we are one of the most leading self-directed IRA custodian, we do not charge percentage-based fees or portfolio value-based fees. It's a flat rate fee. For instance, For a year, it's $420, charged $105 a quarter. Everything else is a transactional fee, like to set up an IRA is $50, to invest is $50. You could have $50,000 in your account or $100,000 in your account. The fees don't change. The reason why we like this pricing model is one, it's affordable. And people like affordable, especially in this economy.
Yeah.
We like affordable things. And one of our key policies at Madison Trust, values at Madison Trust, is we want to make retirement affordable and accessible to everybody. We're not targeting accredited investors. We want to be able to target everyone. So again, it's dependent. I know there are other custodians out there. They do charge based off on portfolio value.
Yeah. Okay. So that's good to know. It's a flat fee, so everyone is well aware of this is how much is going to get deducted every year from my account. And
Exactly.
yeah. And the other thing is can you roll over your self-directed IRA from one custodian to other at the later stage?
Yes, you can. So a self-directed IRA is very similar. It's basically like a normal IRA, but I call it IRA plus because you can do so much more. So you can do the same things you can do with another IRA. You can roll it over, you can transfer it. And honestly, you can even take a distribution out. So let's say your investment, you did a promissory note for a 1 year, it's done. You're ready to just close it, take the money and retire. You can request a distribution, take the funds, close your IRA and retire peacefully.
Okay. So talking about distribution, right? Of course, there are tax implications. But before we go there, maybe if you can explain our listeners a little bit about the traditional IRA versus Roth IRA under the self-directed, and how do they differ? What are the tax benefit, pros and cons, etc.?
Of course. Now, there are 4 types of IRAs. Technically 5 if you take inherited IRAs into account. There's traditional, there's Roth, there's SEP, and then there's simple. SEP and simple IRAs are IRAs when you're self-employed, so we don't see a lot of those. Typically, a lot of individuals select either traditional or Roth. Traditional, the key difference between both of them is the tax treatment. With a traditional IRA, your taxes are deferred. That means at this point, when you fund your IRA, whether through a transfer, rollover, or a contribution, you're not paying taxes on the front end. You're paying taxes when you're retiring or when you're taking a distribution out. Versus a Roth account is what we call a tax-free account. Now, people hear the term tax-free and they're like, wait a minute, I didn't know that was possible. But there are certain requirements you have to meet for a Roth account to be tax-free. So that means when you fund a Roth account right now, you pay the taxes up front. And when you're retiring or when you're taking distributions later on, there is no taxes associated with it. Also, with a Roth account, you don't have required minimum distributions. With a traditional, once you hit 73 years of age, you have to take distributions out and pay the taxes. With a Roth account, you do not have to do that. But again, there are certain requirements you have to meet, whether it's, did you have the Roth account for a certain time? Are you over 59 and a half years old? Only once that certain criteria is met, the investment, your return, your income within the Roth IRA is truly tax-free. Now, there is also, not everyone can set up a Roth IRA, by the way. So if you have a certain income limit, you are not eligible to set up a Roth IRA. So how you can go about it is, there is a very, very interesting strategy called a backdoor Roth conversion, where an investor can set up a traditional account, fund the traditional account because traditional IRAs don't really have those restrictions, and then Roth convert the traditional IRA into a Roth account, essentially paying the taxes upfront, but now you have a Roth account.
Okay. And people tend to do that. They like to convert them into Roth IRA, seems like.
Absolutely. Are you familiar with Peter Thiel? I know this conversation comes up.
Yes.
Exactly. So a lot of people they are dying to get into that strategy, but Peter Thiel did that even before anyone knew self-directed IRAs or how Roth accounts function. But definitely possible.
And I think for Roth IRA also, there is a 5-year period, right? Before your initial investment, you can only do the withdrawal after 5 years. Is that right? Yeah.
So the 5-year period, with us at least, with self-directed IRAs, you can absolutely take the funds out. But if you take it out before that 5-year period, you might get penalized. And
Mm-hmm.
hence why that 5-year period is very important. It's not really a restriction, but rather a tax advantage strategy.
Okay. And now let's talk about the investment perspective, right? Okay, someone has a self-directed IRA. What are the different assets that can be purchased under Roth IRA? And what are the certain assets that are restricted by IRS that you cannot touch?
I think I'm going to answer your second question first because that's the
First,
easier one.
easy. Because the first one has a lot more assets to cover, right?
There are so many investments on the first
Yeah.
one. So the IRS actually restricts 3 things, and not just a self-directed IRA, just in general for IRAs: S corporations, collectibles, and life insurance. So those are the 3
So
types of.
let me, S
Yeah.
corporations, you said. What about LLCs?
So LLCs are fine as long as the tax structure within the LLC is not an S corp. So C
Okay.
corporations are fine, S corporations are not allowed. Again, I'm not a tax professional, so I always recommend people speaking to your financial advisors before going this route. There's a reasoning. It's all because of the tax structure, how the
Okay.
corporation pays taxes, that this is not allowed. But other than that, collectibles. So we're talking antiques, wines, cars, certain coins you can't invest if it's considered collectibles, and of course life insurance. You cannot invest into a life insurance policy using retirement money.
Okay.
Other than that, everything is fair game. And I am talking with about 5 years of experience. I have seen my clients do everything. I have seen my clients do normal alternative investments like real estate, precious metals, crypto. I've also seen them do Arabian racehorses, marinas, boat slips, movies, production, Broadway shows, royalties in new and upcoming pharmaceuticals. They get very creative, Ted, and that's what makes my job so fun, because they come to me, they're like, Donna, can I do this?
Yeah.
And sometimes I'm not even aware, and I have to do some research on the back end to be like, actually, this is possible. This meets all of the requirements.
Nice. Yeah. So you got a vast pool of investment strategies that you can implement under the self-directed. And for the people who are self-employed or have the business of their own, right? They can also open the self-directed IRA account and get the tax benefit by just putting the money either, in the Roth or traditional, depends if they want the tax benefit initially or at the end.
Correct.
Yeah.
Yes. As long as you have some sort of an income, you're able to set up an IRA and you should be fine. And you're able to contribute depending on your income too.
Is there a minimum qualification or like a requirement for the contribution?
So for the contribution, there is a restriction. For instance, it is $7,000 if you're 50 and under, and $7,500 if you're 50 and over. You can't contribute beyond that. But if you have a qualified retirement plan already, so like we discussed earlier, you already have that 401k, then there is no limit because it's already in a qualified retirement plan. Then there is no limit. You can roll it over to a self-directed IRA.
And now let's dive deep into the investment strategy. I'm more interested towards real estate. I know there are many other things you can invest in, but for anyone to invest in real estate, let's say, for example, me, right? I have a self-directed IRA. I have an LLC also, under which I want to buy a property. Can I use my self-directed IRA money to buy the property under that LLC?
Let me ask you a question. The LLC's ownership is very important. Is the LLC owned by the IRA?
No.
So this is where we come across regulations called prohibited transaction. So there are certain individuals that are disqualified to the IRA. And those individuals, we call them disqualified individuals. So if the disqualified individuals transact with the IRA, there's a potential for prohibited transactions. So to answer your question, if the LLC was owned by a non-disqualified entity, yes, your IRA can invest into the LLC to buy the property. But if the LLC is owned by the IRA account holder personally, you cannot use your IRA to invest into it. So what clients typically do is they'll actually set up an IRA LLC within the IRA,
Okay.
fund the LLC, and once the LLC is funded, the LLC is owned by the IRA, right? So now you can go and purchase property. Now, that's if the client wants control, like they want to be hands-on, right? If the client doesn't want control, they want passive investing, what clients do is they find companies, syndication companies, real estate companies who have these offerings, whether it's Reg D, Reg CF, Reg A, they have put together an offering, and let's say the minimum investment is $50,000. They'll invest into the offering directly from the IRA. This way, it's passive investing, so they don't need to do anything, but they still have ownership into a real estate deal. So it's really twofold.
Okay. And when they get the distributions back, it goes back to the IRA. What about there's no capital gain tax or nothing as such, right? They can reinvest, roll over the same money into another investment.
Exactly. Now, because the IRA, again, is under that tax advantage umbrella, you're not paying taxes on it. The only time you are going to be paying taxes is if you take a distribution from the IRA directly. So take it out of the IRA to yourself personally. At that time, depending on whether it's a traditional or Roth, you'll have to pay taxes. But if not, the capital gains taxes, nothing should, the full distribution, the income from the deal needs to come back to the IRA.
Okay. Any complications you have come across while anyone tries to invest in real estate? If you can give just one example where,
I think the biggest complication we've seen is it's really because of not understanding how the process works. With a self-directed IRA, you can invest into the property directly without an LLC, without a deal. So if you want to actually buy a house, like say a vacation property, you can invest into a vacation property and rent it out. The biggest complication I've seen is when when you buy a house, you have the purchase contract. So when you're buying a house through your IRA, you still have the purchase contract, the draft of the deed, the settlement statement. Clients tend to put their personal information, their personal name as the buyer instead of the IRA. When you're buying property, when you're getting into any investment using your IRA, Ted, it has to be the IRA. So it's like, say, Ted Patel, the Madison Trust Company FBO, Ted Patel, and your Madison Trust account number. It cannot be Ted Patel for you to use your IRA funding. It's not a huge complication because typically we're able to work with the client to revise the documents, but it's one of those things that it looks like you're investing your retirement money to own something personally, which could constitute for a prohibited transaction.
And the other thing is, even if you're buying a property through an IRA, you cannot live in the property, right?
Exactly. Correct. Because the IRA account holder is disqualified individual to that property, you cannot live in it. You cannot even do anything in the property. For instance, like what we like to say is don't even change the light bulb in your property. Stay away from the property. Rent it out. Have a property management company to take care of everything for you. Just arm's distance.
Arm's distance. Yeah, that's good. All right. And like there are few things, right? Within self-directed IRA also, UBIT and UDFI. So if you can give our listeners a little bit more background about how those taxes, how these are taxed in IRA.
Of course. So UBIT and UDFI, there are two different types of taxes that very rare, would apply for self-directed IRA investments. UBIT is unrelated business income tax. And UDFI is unrelated debt tax. Now, for UBIT, the reason these even come up is the purpose of a self-directed IRA is for passive investing, right? The minute it turns from passive investing into active investing, like active cash flow, like an active business. And the best example I use is like a pizza shop. Pizza shop has income coming and going every single day, right? That's not passive. That's active.
Active.
A pizza shop most likely will have UBIT because of the active cash flow. UDFI is something very different. UDFI is when there's a loan associated with your investment in an IRA. and it has to be a non-recourse loan because you cannot have a conventional loan.
Yeah.
Then the percentage of the loan that was used, a loan amount used for the investment, there will be a tax on that. And all of the time, whenever there's UBIT or UDFI, the taxes need to be paid directly from the IRA itself. Now, people do worry when they hear these terms. Wait a minute, I thought in IRA you don't have taxes. Like I said, this is very rare. I actually never see these instances. I might have seen this instance like 3-4 times in my entire career because it's far and few. Having a rental property and renting a property out, it will not cost UBIT. However, if you bought the property with a non-recourse loan, now it will have UDFI.
So if you have a debt on the property, then you have a UDF. And like, let's say 50% is of a debt. So is it like 50% of the income would be taxed?
Correct, exactly. It's percentage based. So what is the percentage of the debt that is associated with the investment? That amount will be taxed, not the entire income.
Okay. But in case of the passive investment in the syndication, none of them get taxed. Is that right?
Correct, exactly. Typically with syndications, we don't see UBIT taking place. Again, it's really understanding what is passive versus that active cash flow. If it's an everyday business where money is coming in and going every day, which syndications, you don't see that. There is typically with syndications, the first few years, you don't even see a cash flow. It's not active investing. So syndication, it's far and few.
All right. And now let's talk about the distributions, right? You said you can take the distributions after 59.5 years.
So yes, so once you hit 59.5, you no longer have penalties. Typically, if you try to take a distribution before 59.5, you get a 10% penalty on top of the normal tax that you have to pay. But after 59.5, depending again, the right account. If it's a Roth account, if you meet the criteria, there's no taxes. But if it's a traditional account, you still have to pay normal income taxes after 59.5, but there's no penalty.
All right. And can you write a loan to yourself from the self-directed? Okay, that's let's see.
It's a great question. I do get this all the time. So I know there are other qualified retirement plans you can take loans out from. Self-directed IRA is not one of them. You cannot loan yourself money because again, we are going to the prohibited transactions, right? You're a disqualified individual, so you cannot take money out from the self-directed IRA as a loan. That being said, can you loan money out of a self-directed IRA to a non-disqualified person? Yes. So you could have a friend who has a business that needs cash. You can absolutely loan money from your IRA in the form of a promissory note to your friend, and your friend can then pay the principal and interest back into the IRA. That is absolutely fine, but you cannot give your own self a promissory note.
Awesome. All right, so that can work out, like, you can all, and on the interest, of course, there's no taxes on the interest received back from that loan. All right.
Correct. There's no taxes unless, of course, you're taking it out from the IRA's tax advantage umbrella.
Okay. All right. I think we covered most of the things. Anything that in particular you'd like to highlight about the self-directed IRA, which we haven't covered?
I really like that we are getting more and more conversations around self-directed IRAs because Ted, they have been in existence since 1975, but it's only in the last few years everyone's starting to know about self-directed IRAs. So what I would love to say is if someone is thinking about diversifying their portfolio, taking more control of their retirement account, definitely look into self-directed IRAs. And if you're not sure, our site, MadisonTrust.com, we have it's a wonderful resource. It's a wealth of resources, which will give you a more understanding on what is a self-directed IRA and what can you do and what you can't do. So definitely do the research and you'd be surprised. A lot of people will understand this is a fantastic investment strategy for them.
Yeah. Before we jump on the final round of questions, one more thing I wanted to ask, like, what is the process? Like if anyone wants to use the money from self-directed IRA to purchase the real estate, the process, like you have to connect with your custodian account, you have to file the paperwork. That process, what is it?
Okay, so I'll use us as an example because we
Okay.
actually like to keep the process very simple. You can
Mhm.
open up your IRA. We have a quick 10-minute online application, whether it's traditional or Roth. You can set up your IRA account at Madison Trust in 10 minutes, and then you will let us know how you like to fund it. Is it a
Mhm.
rollover from another 401k? Is it a transfer? Is it a contribution? You'll work with our transfers team. We'll get the account funded. At the same time, let's say you're purchasing actual tangible property, a beach house, great.
Mhm.
You'll work with our investments team. You'll provide the investments team with the documentation, the purchase contract, the settlement statement, draft of the deed. Now, if it's a syndication deal, it'll be private placement memorandum, subscription documentation. We
Okay.
will review it, not as a risk analysis, but a due diligence to make sure your retirement money can be used to invest into it.
Okay.
We'll also walk the client through the process of completing the documentation. And once all of that is done, the client will tell us, all right, Donna, everything looks good. You can wire the funds to either the title company to buy the property or to the syndication deal to invest, purchase the shares of the offering. And that's it. Open fund invest. We keep it simple as 1, 2, 3. And here at Madison Trust, we actually can turn things around in 2 weeks or under.
Awesome. That's great to know. All right. Hey, Donna, I'm really enjoying this conversation. I think we can talk for hours and hours on this this topic, but wanted to be respectful of your time also, so we'd like to
Or
jump to the final round of questions. Are you
let's
ready?
go. Yes,
Yeah.
hit me.
Okay. All right. The first one, which is the one book that you'll recommend to our listeners?
So the one book I would recommend right now is Atomic Habits by James Clear.
Yeah.
I think it's a great book for your personal and professional life because there was this one line from that book I really enjoyed. It's all big things come from small beginnings. And it's so true for your personal and
Yeah.
professional life. The little things really add up, and that's when you see results. You don't become a millionaire overnight. Unless you win the lottery, that's different.
Yeah.
That's totally different. But
Yeah.
everything, right? Whether you're a bodybuilder, you go to the gym every single day until you see results. Whether you have your own business, you work on it day and night. So I love that book. That book really helped me be more disciplined and consistent with both my professional and personal life. It's a must read.
Yeah, it is. It's one of my favorite too, actually. It's a good
I love
read. Yeah.
that.
All right. So what is your main source of information to learn and grow?
So for me, one of my main sources of information, of course, is everyone in finance reads it, the Wall Street Journal, the Economist, Forbes. But for me, it's also, I do a lot of traveling and I meet a lot of people in my industry. So just talking to them, understanding the trends, what's up and coming really helps me be up to date with our industry trends. And that's great because knowledge is power, and that'll never change.
That's absolutely true. Yeah. All right. And what is the best advice I would say business or investment advice you'd like to give to our listeners?
Research, research, research. That is
Yeah.
the one advice I tell everybody. Don't assume things. We were just talking about this when we began this
Yeah.
conversation. Don't make assumptions. Don't believe everybody. You need to do your own due diligence, especially in this field where alternatives are such a gray area sometimes. I'm sure some people who might be listening today wouldn't know that you can invest into real estate using an IRA. But just because you know that now, don't jump into buying the first property you see with your IRA. Do some research,
Yeah.
understand, is this property good? Is my financial situation good for me to actually diversify my retirement portfolio into alternatives? Do the research, ask questions. If you don't know, talk to experts, ask the right questions, ask all the questions. Sometimes I have clients, they'll set up multiple appointments with me. And I like that because that means they're doing their due diligence to make right, sound financial decisions. So that's the one piece of advice I will give everyone in this, just in general in life, do research, especially when it comes to your money.
Absolutely. And after doing research, take some action. That's what I like to add.
Yes, I love that.
Because people will keep doing research for 6 months, 12 months, and just, they will
Yes.
never pull a trigger.
You have to do research and then take action. I like to revise that. Research, then take action.
All right. All right. Donna, final questions. How can Decoding Cashflow listeners get in touch with you?
Well, this is my favorite question. Definitely visit our site, madisontrust.com/sponsors. And if anyone would like to continue the conversation with me, set up an appointment with me, you can definitely use my link there and set up a call with me.
Awesome, Donna. It was a pleasure talking to you. There are a lot of golden nuggets shared on this show, and I'm sure our listeners will benefit out of it.
Perfect. Thank you so much for having me, Ted.
All right. Thanks a lot.
Thanks for listening to Decoding Cashflow, brought to you by Aster Capital. If you found value in this episode, then please share it with someone who you think could benefit from it. And make sure to act on what you've learned. If you want Ted Patel to personally help you reach your goals, then feel free to set up a one-on-one call with him. Also, visit us at astercapital.com for more free resources. Content of this podcast is for informational purposes only. As always, please consult your own advisor before making any investment decisions or setting a course of action. Thanks again for joining us on this episode of Decoding Cashflow, and we'll catch you in the next episode.